Hi, I'm Laura Iriarte, Head of PR and Communications at 0100 Conferences, and I am very happy to have today with us Karey Barker, Founder and Managing Director of Cross Creek. So, Karey, please tell us a little bit more about Cross Creek. What is this? It's a fund of funds, right?
Yes, we are, and thank you for having me. Really excited to be here. So we're based in Salt Lake City, Utah, and we are a venture platform, and by that I mean we really started by investing in late-stage direct companies. We came from a public heritage of public investing, and that's my background with small-cap public growth stocks. So we started investing in late-stage public companies and then quickly added a fund of funds platform where we invest in leading venture funds to give us sort of the visibility and access to the venture market. And we're actually going to be 20 years old next year, so we've been around for a little while.
Wonderful. And now you're here in Amsterdam, right? So what is the current appetite among international investors for European VC funds? No, are you currently investing as an LP here in Europe?
We have been investing in Europe for quite a long time, but it's a small percentage of our portfolio. We really started as a U.S. venture fund of funds. And, we can generally, by our charter, we can have up to about 20%. Outside the U.S., we've been growing that a little bit, but we've never been close to that threshold. And primarily it's been Europe, a little bit of Israel, and a little bit of Asia, South Korea, not so much China, some markets like that. But we're getting much more interested in Europe for a variety of reasons. And in the last couple of years, our team has been spending a lot more time on the ground in Europe, meeting primarily with European funds. We're not doing a lot of European direct investing yet, but we're meeting with a lot of European venture funds.
And what sectors are you looking for?
Really all sectors. We've had some long-term commitments in technology, mostly software and cyber across, really in sort of the most established markets, sort of focused on, London and Germany. But we're looking to expand our sectors. We don't currently have a lot of exposure into healthcare, either tech bio or life sciences. So that's an area of interest for us. Obviously, the deep tech talent in Europe is amazing. And we're talking to some deep tech managers. We think that's an area of interest and really expanding sort of the footprint, the tech talent in Eastern Europe, very interesting. There just hasn't been the venture capital sort of maturity or really, we're not a big fund. We need the ecosystem to mature, and we're really seeing that happen in a lot of ways and has attracted our interest. I can't speak for other global investors in general, but I certainly see from my peers in the U.S., more and more interest in investing in Europe.
And what will be the difference now from the LP perspective and when you're evaluating European VC funds? What specific challenges do you see in the due diligence process, and what main differences do you see between our funds here in Europe and the funds in the U.S.?
That's a great question. There are regional VCs in the U.S., but honestly, they haven't had that much traction. The U.S. is obviously, in terms of borders, regulation, language, culture, it's much more, homogenous than Europe. And so, that's been one of the challenges, I think. And even the capital, the LP capital in Germany, also a lot of it is related to, governmental capital, and it has certain restrictions by where that capital can be invested. So for a variety of reasons, Europe is a little more difficult in terms of, it's not, a lot of the funds call themselves pan-European funds, but it's not as easy, I think, as it sounds. It's much easier to be a pan-US fund if that was a thing. So there's some of those challenges, and we really try and understand the funds we're looking at, and do they have the people in the right locations to get, to access to the markets. Some of the markets are a little more insular. So do they really have, access? And we do worry about the capital, and is the capital they've accepted, limited their ability to operate. So there's a few unique challenges that probably don't exist in the U.S., but there's also a lot of things that are the same. It's just network and expertise and track record, and, it's probably 90% the same, but there are some nuances for sure.
And for example, because something that we always mention during the conferences and during the panels is regulation, right? So what do you think, how can we improve, or what should be done as Europe, to be more attractive from the American perspective, right? Because you were saying, European fund then is not the same to invest in Germany than investing in.
The regulations in Europe, there's a variety of regulations that we think have limited the venture capital in Europe. Companies grow fast that are venture backed and they hire and sometimes need to let people go. So those kind of regulations around employment and severance, I think, have been problematic in some countries. But probably more importantly is just the access to capital. So both in the U.S., corporate pension and university endowments were really the ones that really gave venture their early big capital and set the whole venture ecosystem in motion. That capital, it doesn't exist in the same way in Europe. And my understanding is some of that's regulatory, that the corporate pensions aren't allowed to invest in certain risky asset categories. I think that's changing with some new regulations in countries like the UK and I believe here in the Netherlands. But, I think the way insurance companies are regulated also, in the US, they have to make up for the J curve in venture with their reserves, but they don't have to categorize some of those as a stressed asset. So again, I'm not an expert on European regulation, but I do think that there's been a lot of regulatory things that have limited the venture ecosystem in Europe more than the US. But I also understand that a lot of those are changing. So that's another reason why we're getting more interested in Europe.
Wonderful. And about what you do, right? Because Cross Creek invests in partners with both venture growth managers, and also I think you work with established managers, but also emerging managers, right? So that's a very a full strategy. You cover everything. So how do you manage this? How do you balance this strategy?
We really focus primarily on what we call core managers, and a core manager for us is a very proven manager. We don't like funds that get too big, though. So a lot of the brands that most people would recognize in the U.S., we actually have moved away from because we feel like very large funds struggle to perform. It's just they're too diversified. So we like to say that our favorite and our funds and our biggest allocations are funds that could raise billions but choose not to. And so we love a fund that's, sub billion sort of per fundraise, generally in the 200 to 500 million, but has very long-term excellent performance. So that would be our core manager group. But then we also back funds that we call focus funds. We don't call them emerging, mostly because they're usually proven investors, proven GPs that have been in a larger fund and have spun out. So, and they're focused usually on a narrow sector or maybe a geography. And we really, if you're going to be a small, new venture group, you need to have an expertise. And that expertise might be cyber, it might be fintech, it might be something else. But trying to be everything to everybody, multi-stage, multi-geography for a small fund isn't very effective. And so our focus managers, are smaller managers, but proven investors that are doing something very focused and attractive to the entrepreneurs because they're experts. We occasionally do a first-time fund, but not usually. But if we do a first-time fund, it's usually a spin-out of a manager we know.
Wonderful. I think it's very clear strategy, actually. And it's very good because because we need with people to invest in all types of not only established funds, but also people that are trying to get into the ecosystem, no? And just to finish, looking ahead, 2025, now we're desperate for IPOs. So what do you think is going to happen this year with the current situation, no?
That's $1 million question. Multiple times in the past 2 years, we've thought the IPO market was going to open. We've had 1 or 2 deals get out. They're very high caliber deals in terms of large scale, generally growing and profitable. So the triple win. But each time something geopolitical happens that kind of stalls the market, and we just haven't seen the IPO market open for a broader group of companies. We haven't seen, the high growth but not yet profitable companies really test the market. It's been a very narrow set. We were hoping with the election behind us, the markets would open up. CoreWeave got out last week. They didn't do as well as hoped. There's some high profile things on filing like Klarna. We'll see how those do. But I'm a little skeptical that, with the market's volatility, that markets don't like uncertainty. And I think with the current volatility, I think it's going to be difficult for riskier companies to come public. But all that said, I also don't think there's that many candidates. I think this notion that there's 50 years of unicorns, this sort of pent up, demand for IPOs. Actually, most of those companies that raised a lot of capital at high prices in 21 and 22, they didn't want to raise additional capital the last couple of years. They've tightened their belts. They've shrunk their burn, but they've also lowered their growth rates. Many of those companies are growing slowly, and maybe they're break even. They're not IPO profile. 15% growth break even company, even if they have scale, is not an IPO candidate. And so we actually don't think there's that many companies that could come, even if the market was open. But I'll throw in one exception that everybody ignores. The biotech IPO market and the M&A market has been strong, maybe not in terms of valuations, but in terms of quantity. It's been a steady flow in biotech. And people often forget about life sciences when they're talking venture. Everybody's focused on AI and tech. But we're about maybe 15 to 20% biotech exposure on our fund of funds platform. And it's delivered 80% about of our liquidity from our funds in the last couple of years. So there is some liquidity, but it's in some unique sectors. It's not your big tech IPOs.
And I think Europe is a very good place for biotech, right? And life sciences. We have great universities, great scientists. So
that's an area we're looking to get more exposure, not only great university and great scientists, but also big pharma. Obviously, Europe has some very large pharma companies that are developing as well as buying. And they've been buying, both European and US backed venture companies pretty aggressively. Both European and US big pharma have weak pipelines. A lot of things have come off patent, and they're anxious to fill their pipelines with venture-backed companies. So that's an area. Well, I know the biotech funds are not thrilled with, their valuations went way up and have come down as well, but at least they're getting activity and liquidity, both M&A and IPO. So we think that's a little bit of a sweet spot in venture, and an area that we do think Europe's strong and we'd like to have more exposure.
Wonderful. Thank you very much.